This question will walk through the accounting for a defined benefit pension plan. Monday Corporation sponsors a defined benefit pension plan and reports under IFRS. On January 1st, 2020, the company reported plan assets of $1,000 and a defined benefit obligation of $1,100. All amounts in thousands of dollars. So we need to add 3 zeros to all these numbers. During 2020, the current service cost was determined to be $90,000. The discount rate on the DBO and plan assets was 6%, while the actual return on plan assets for the year was $55,000. Monday made contributions of $92,000 into the plan at the end of the year, and the benefits paid amounted to $64,000. The plan was amended effective December 31st, 2020, with the cost of past service benefits granted being $40,000. Determine the deficit of the pension plan at January 1st, 2020, and calculate its December 31st, 2020 deficit balance directly by identifying which 2020 pension events increased the deficit, which decreased it, and which had no effect. All right, so the best way to manage the information in this question is to use a pension worksheet. And I've set one up here. So you can see I've got debits are not in brackets and credits are in brackets. Got items where I'm going to list out the transactions. These amounts are going to be in the ledger of the actual company. It's IFRS, so I've included an OCI column. And these are memo accounts, meaning that they're actually in the pension plan itself. So they're not in the books of the company, but we need to know what's going on so we can pick up any unfunded amount or surplus. So let's take a look at the question again. So on January 1st, 2020, the company reported plan assets of $100,000. I guess this is $1 million, and a defined benefit obligation of $1.1 million. So it says all amounts are in thousands of dollars. So we've got one, which one was C? Plan assets of a million. So plan assets of 1 million, right? And then a defined benefit obligation, which is a liability of 1.1 million. So what is the net defined asset or liability as our opening balance January 1st, 2020? Well, it's going to be the difference between these two amounts, meaning that the plan is unfunded by $100,000. We've got a liability of 1.1, but we've only got plan assets of $1 million. So we've got a negative $100,000 net defined asset or liability. Okay. So we picked up that one. So this one says, so in the question it says, determine the deficit of the pension plan on January 1st, 2020. So we did that. We've got this one done. So now let's see what else we've got in this question. During 2020, the current service cost was assumed to be $90,000. So let's record this current service cost. So where are we going to record this $90,000? Well, it's going to increase our pension expense. So we're going to debit pension expense, and it's also going to increase our DBO in the plan. And so current service cost reflects the fact that the employees are working, and as the employees work, they're increasing the future value of their pensions when they retire. So that's what this is reflecting. As the employees are providing the service, we need to recognize an expense to do with the pension in the company. And this is also going to increase the future payments that are expected under the plan, which is this defined benefit obligation. The discount rate on the DBO and plan assets was 6%. So the expected return on plan assets and the interest cost on the DBO offset. And this is probably the more complicated part of accounting for defined benefit pension plan. So the first thing we're going to want to do is calculate the expected return on plan assets. So we're told that the expected return is 6%. It does say in the question that the contributions were made into the plan at the end of the year. The reason that that's important is if the contributions were made into the plan at the beginning of the year or throughout the year, we would need to consider that when we were calculating the expected return on plan assets, because we would have had more cash throughout the year on a weighted average basis. But because the contributions were made at the end of the year, we can assume that for like 99.9% of the year, we only had $1 million. So our expected return is going to be $1 million times 6%. I think that's 1 million. So that is going to be our expected return on plan assets, and that is going to actually decrease our pension expense. So 1 times 6%. So we've got, this is going to decrease our pension expense by $60,000, and it's going to increase the value of our plan assets because we're expecting our plan assets to be worth an extra 6%, which we can use to pay out some of our obligation under the plan. So we can use it to offset our pension expense. But at the same time that we're expecting to earn interest on plan assets, the DBO is present valued. So let's just assume that retirements are going to start in 10 years. It's a little bit simplistic, but as that 10-year period gets closer and closer and closer, we need to increase the value of the obligation because the time value of money is increasing. So our interest cost on the DBO is going to be is going to equal 1.1 million. Sorry, 1.1 times 6%. I think that's right, 1.1 million. I might have an extra zero in there. Yeah, I do. Okay. So then this is going to increase our pension expense. So we're going to have 1.1 times 6%. So we're going to be increasing our pension expense by 66,000. And this is also going to increase the future of this defined benefit obligation, the future payments. So this is a credit balance. So to increase it, we credit it. So from a net perspective, the net between the expected return on plan assets and the interest cost on the DBO is going to be a net of a $6,000 expense. Okay, now we're told that the actual return on plan assets was 55,000. So we picked up these things, so 55,000. So what happens there? So we've got a remeasurement of plan assets. So we earned, what was it? 55,000. So we thought we were going to earn 60,000, but we actually only earned 55,000. So we earned 5,000 less than we thought. So we have a loss. So we need to record this loss. Now, under IFRS, this loss is required to be recorded through OCI. It would seem reasonable to record it in pension expense because that's where we recorded the expected return on plan assets. But because it's a remeasurement, meaning an actual return, that's different than the assumptions under the plan. So pension plans are based on assumptions. So because this is outside of our assumptions, it's an actual return, it's going to go through OCI. Now, OCI is part of shareholders' equity, so it has a credit balance, but this is a loss. So to decrease OCI or show a loss, it's going to be a debit. Was it 6,000 or 5,000? Sorry. 55,000, and we had 60,000. So this is going to be 5,000. And the other side of this is going to be a decrease to plan assets. So plan assets weren't worth 60,000 as we thought. They were worth 55,000. Okay. Now it says Monday made contributions of $92,000 into the plan at the end of the year. So let's go employer contributions. No memory of these numbers. Where was it? 92,000. Okay. So employer contributions are going to decrease cash. So we're going to credit cash. Is it 92,000? Decrease cash, and they are going to increase our plan assets because we're basically moving cash, if you will, from the company to the plan. So let's just say we're decreasing our cash share and we're increasing the value of our assets. You can also think of these assets just as cash. And the benefits paid out under the plan. So we got the 64. No. The 92, sorry, and the benefits paid out were 64,000. So benefits paid. Now, this is not going to decrease the cash of the corporation because the benefits are paid from the plan. The employer contributes cash into the plan, and then the plan pays out the benefits. So the benefits paid of 64,000 was 64,000, right? Yeah. Are going to decrease the assets of the plan because we're taking cash out of that account, if you will. And it's also going to decrease our future obligation because as we pay out the benefit, we have that much less that we have to pay out in the future. And the plan was amended effective December 31st, 2020 with the cost of the past service benefits granted being $40,000. So past service cost. Now, past service cost is where we've said we've looked at someone under the pension plan and we've decided that we'll give them additional benefits that had to do with earnings that they had in the past, so service they provided in prior years. And both IFRS and ASPE require this amount to go straight through in net income. So this doesn't go through OCI, even for IFRS, it goes through net income. So we're going to have $40,000 here as an expense. And of course, this is going to increase, sorry, this is a debit expense. And this is also going to increase our future obligations under the plan because now we've said, hey, you know what? You actually should have earned an extra $40,000. So of course we have to reflect the fact that we now owe an extra $40,000 under the plan. And that needs to be an expense on the books of the company. And that takes us through all the information. So let's total the accounts in our pension worksheet here. Okay, run this across. Okay, so we've got a debit balance of OCI, so we're decreasing OCI. We've got pension expense of $136,000. We've decreased the company's cash, and we've got a defined benefit obligation in the plan of $1.232 million, and we've got plan assets of $1,083,000. So is the plan underfunded or does it have a surplus? Well, the offset between these two things is $149,000. So we're short $149,000 in the plan. So we had an opening liability here. So now we are going to have, this is going to be our new plan deficit, which is going to be the difference between these two things. And this is what we are going to record in the financial statements of the corporation itself. So this is going to be a liability on the statement of financial position showing that we have underfunded the defined benefit pension plan by $149,000. And the reason that this shows up on the statement of financial position of the company is because it's the company's responsibility to make sure that their promise to pay out whatever they've agreed to under the defined benefit pension is held true. So if the plan assets are less than expected or the benefit obligation is somewhat higher, the corporation's on the hook for that. So they're going to need to contribute more to the plan so that it's properly funded in the future. So that takes us through this question.